Welcome to Talk Tickers. So, Intuit just dropped their earnings, and boy did they send a message to Wall Street. The headline, AI is here and it is absolutely fueling some massive growth. Today, we're going to break down those impressive numbers, unpack the AI strategy behind it all, and figure out what it means for the stock going forward.
So, first things first, how did the market take the news? Well, the stock jumped a solid 4%, and look at the volume, double what's normal. Now, that's not just a little blip. That's investors putting their money where their mouth is, giving a huge vote of confidence in what the company's selling.
And why did they react so strongly? Well, here are the headline numbers. Intuit didn't just meet expectations, they blew right past them. Revenue came in 3% higher than Wall Street was looking for, and earnings per share, they crushed estimates by 8%. You know, all those pre-earnings jitters and skepticism pretty much silenced overnight.
All right, let's zoom in and really look at the key numbers that powered this monster quarter.
You know, what's really fascinating here isn't just the growth, it's the quality of that growth. Okay, revenue up 18%, that's impressive on its own. But look at this, earnings grew almost twice as fast, up 34%. How? Through a massive 340 basis point expansion in their operating margins. That's just pure, beautiful efficiency.
And this growth wasn't just a one-trick pony. It was firing on all cylinders. Global Business Solutions up 18%, the Consumer Group up 21%, but the real head-turners? You had a resurgent Credit Karma growing at a whopping 27%, and the core QuickBooks Online business just humming along at 25% growth. Oh, and just to sweeten the pot, they threw in a 15% dividend hike.
So the big question is, what's the secret sauce? What's really powering these incredible results? Well, on the earnings call, management couldn't have been clearer. The answer, in 2 letters, is AI. For Intuit, this isn't some buzzword they're chasing. It's become the absolute core engine of the business.
And just listen to the language from the CEO, Sasan Goodarzi. He didn't just call it a good quarter. The words he used were outstanding and exceptional AI-driven quarter. See, this wasn't just about hitting the numbers. This was about proving that their entire AI platform strategy is the real deal, and it is working right now.
And this isn't just some high-level corporate talk either. This stuff is translating into real value for their customers. Their new accounting agent, for example, is already saving small businesses up to 12 hours a month. Think about that. That's a day and a half of work a business owner gets back every single month to focus on, actually running their business.
And check out the impact on cash flow. The payments agent is helping customers get their money 5 days faster, on average. Now, if you've ever run a small business, you know cash flow is king. Getting paid almost a full week earlier, that is an absolute game changer.
And then, as if the quarter wasn't strong enough, just 2 days before they reported, they dropped this bombshell. A huge, multi-year, $100 million plus deal with OpenAI. This is going to deeply wire OpenAI's models right into Intuit's products. It's like they're pouring rocket fuel onto their entire AI roadmap.
Okay, so that's the story of the last 3 months. But what about what's next? Let's talk about their guidance and the tone from management.
Now this part's really interesting. Even after that huge beat in Q1, management didn't raise their full-year guidance. They just strongly reiterated it. Now you might think, is that a bad sign? But actually, in this kind of choppy economy, holding firm on guidance for double-digit growth like this, that's not caution. That's a powerful signal of confidence that they see this momentum continuing.
So this really sets up the core debate for anyone looking at this stock. The bull case is pretty obvious. AI is working, they're making money from it, and the platform is growing. But the bears, well, they still have some lingering concerns. They're pointing to slowing growth at MailChimp, wondering if Credit Karma is sensitive to the economy, and asking the big question, is the stock's premium price tag really justified?
So, after sifting through all of this, what's our take? Where do we think Intuit goes from here?
For us, when you put it all together, the strong AI-powered beat, combined with that confident guidance, it sends a really clear signal. It feels like the bull case is winning the argument right now, and the whole narrative around the company has really shifted for the better.
So our analysis points to this outperformance continuing. First, we're expecting another beat next quarter, mainly because we think the adoption of those AI tools is only going to accelerate, and Credit Karma still seems to have a lot of momentum. Second, we think that's the catalyst that's going to push the stock higher and break it out of the sideways trading range it's been in recently.
So based on that whole outlook, we are initiating our rating on Intuit at Outperform. We really believe the company's positioned to do better than the broader market, and it's all driven by the fact that they are successfully and tangibly monetizing AI within a durable, high-margin business that's proving just how resilient it is. And as always, please remember, this analysis is for informational purposes only. It does not constitute financial advice.